Hello, welcome to Module 15 entitled Break-Even Analysis, Decisions and Constraints. One of the key features of this module is to discuss how accounting can help the marketing. In particular, the decision-making areas we'll consider include how much sales do we have to make to break even? This is a question which marketing people constantly ask accountants because they need to know their minimum sales. What's the most profitable product line? Again, this is important for marketing because they need to know which product lines to push or which to drop. So, should we drop any products based on our profitability analysis? If so, which? So these are the issues we'll be considering today. In many senses, this is an important module. In order to really understand this module, we have to go back to some of the concepts we discussed in previous modules. For example, the concept of variable cost, fixed cost, and mixed cost. So if you're not sure about those cost concepts, take a few minutes and refresh your memory before getting back to this module. In this module, there are a few new concepts that you need to know. These are the concept of break-even point and break-even sales. Let's consider this for a few minutes. Break-even point. Break-even point is defined as the point where sales revenue exactly equals total costs. So it's the point where profit equals 0. Let's see how this looks in a graphical form. We have dollars on the y-axis and output measured as units on the x-axis. Take a few minutes. How would the sales revenue line look like? It would look like this. When you sell 0 units, your sales revenue is 0. And as you sell more units, it goes up in proportion. How would the total cost line look like? It will look like this. Remember, total cost has variable cost and fixed cost. So even when you don't do anything, you have fixed cost. That's why it starts high up. Then as you make and sell more, the costs go up. The left side is called loss area, and the right side of where the two lines intersect is called profit area. What's the break-even point? It's the point where sales revenue intersects total costs. That's the break-even point. As I said before, left of the break-even point we call loss area, and to the right we call profit area. Now, let me pose a few questions. In each of the scenarios I'm going to give you, tell me what would happen to break-even point? So let's look at our first scenario. How will break-even point change if unit variable costs increased? That's raw material cost or labor cost. Take a few minutes and try it, and then start this recording. Well, the slope of the total cost line will increase. So as you can see, that's the new total cost line. Fixed costs don't change, so the new total cost line starts at the point of the old total cost line. The break-even point will move to the right. That's the point where sales intersects with the new total cost line. So it moves to the right. Let's take another scenario. How will break-even point change if total fixed costs increased? Example of fixed cost is rent. You want to try it? Stop this recording if you want to. Here's the answer. The total cost line will move upwards. It will be parallel to the old cost line. That's the new total cost. So the break-even point will move to the right. There you go. Let's take another scenario. How would break-even point change if the company was able to increase the selling price per unit? Now you should be getting it, so this should be relatively easy. The sales line will move to the left. This is because you get more revenue per item sold. So it will look like this. That's the sales revenue line. The break-even point is where the new sales line intersects total cost. So it will move to the left, like so. Now, this is going to be a tricky one. How would break-even point change if the corporate tax rate was increased? The corporate tax rate, I'll give you a hint, is based on profit. So, for example, let's say the company tax rate was 20% and they increased it to 30%. How would break-even point change? Why don't you think about it for a couple of minutes? Here's the why. At break-even point, profit is zero. At zero profit, whether you charge 20% or 30% or 50%, the tax impact is the same because profit is zero. So the answer to this is there's no change in break-even point. Just remember that when you do the problems, an increase in tax rate does not emphasize, does not change break-even point. Before we go on, let's do a problem. It's going to come up next. Here it is. A company makes a product with a fixed cost of $400,000 and a variable cost of $100 per unit. The selling price is $200 per unit. Required: A. What's the break-even point for the product? B. How many units must be made and sold to make $50,000 profit? Part A, give me the break-even point in units. Why don't you stop this recording and try it, and then restart when you're done? Are you done? Here's the answer. Let's assume X units to break even. What we do is you go back to basics. Sales minus your variable cost minus your fixed cost equals profit. Do you buy that? Sales less all your cost give you profit. So what's the sales revenue? It's $200 per unit. So for X, the sales revenue is 200X. The variable cost is $100 per unit. So X units is 100X. The fixed cost is $400,000. We're talking break-even point. The profit at break-even is 0. Now it's high school algebra. You got to solve for X. So 100X equals 400,000 and X equals 40,000 units. So you have to sell 40,000 units to break even. That wasn't too bad, was it? Let's have a look at part B. Go back, use the same methodology. Assume you got to sell X units to make a profit of 50,000. Go back to basics as before. Sales less your variable cost less your fixed cost give you profit. So 200X minus 100X minus 400,000. This time you want to make a profit, so it's not 0. The profit is 50. So solve for X. 100X minus 400,000 equals 50. 100X equals 450,000. So X is 45,000. You have to sell 45,000 units to make a profit of $50,000. We started easy. Before we go on, I want to make the point that companies generally produce two types of reports, two types of income statement reports, one for external users, one for internal users. The one for external purposes looks like this. Does this look familiar? It should. We did it before. This is a type of statement given to the IRS. Start with sales, less cost of goods sold, give you gross profit, less expenses, give you net income or profit. The next one, for internal reporting, outsiders like the IRS do not see it. It looks like this. Start with sales, then you subtract variable cost. The difference, sales less variable cost, is called a name. It's called contribution margin. So for future purposes, contribution margin is sales less your variable cost. Then you knock off your fixed cost and you arrive at net income or profit. So this is the type of report used for internal reporting. Now, here are some formulae you need to know. These formulas are in your book, but if it helps, you can print this out. At break-even point, sales in units equals fixed cost over contribution per unit. If you go down, at break-even point, sales in dollars equals fixed cost over contribution margin ratio. What is contribution margin ratio? We'll come back to that a little later on. Look at the right side. At any other point means when you make a profit or a loss. The formula is sales in units equals fixed cost plus profit over contribution per unit. If in a problem they asked you what's the sales in dollars, it equals fixed cost plus profit over contribution margin ratio. Now that you got your formula, let's look at our very first problem, the Sweet Music Company. Here it is. They make CD players. For the next quarter, the expected sales is 600 players. The selling price is $2,500 per player. The variable cost is $1,750 per player. The fixed cost is $300,000. Take a few minutes and print this out, and print out the questions on the next slide. Here are the questions. There you go. A, what's the break-even point in units? B, what's the break-even point in dollars? C, if 600 units are sold, what's the profit or loss? In D, you have to evaluate how good the marketing strategy of the new marketing manager is. Is it a good strategy or bad strategy? And I'll give you a hint how to do that. What you do is compare the profit when 600 units are sold, that's before the strategy, and compare the profit if you implement the strategy. If the profit is greater when you implement the strategy, it's a good strategy. If the profit is lower, it's not a good strategy. And final question. If you want to make a profit of $300,000, what level of sales in dollars is required to yield a profit of $300,000? So they want to know, we want a bottom line profit, $300,000. How much do we have to sell in dollars? There you go. So you have 5 parts to this question. What I'd advise you to do is to stop this recording, print out the case and the questions, try it for yourself. You do have the formulas in front of you. Try it, and then come back to this. There's just one thing you need to know. Contribution margin ratio is either contribution per unit over selling price per unit, or total contribution over total sales. There you go. You got the missing link. Now you can try this question. When you are done, start this recording and I'll go through the answers with you. Are you done? Here goes. The first step in any problem, regardless of whether they asked you or not, is figure out contribution per unit, regardless of whether they asked you or not, because it's going to come in useful. So in this case, let's figure out contribution per unit. Here it is. The selling price is $2,500 per unit. The variable cost is $1,750 per unit. So the contribution per unit is $750. The next step, irrespective of whether they ask you or not, figure out contribution margin ratio. So contribution margin ratio is contribution over selling price, which is, one more time, contribution margin ratio is contribution. You could do it on a per unit basis or in total. Doesn't matter, get the same answer. So what's the contribution margin ratio in this problem? The contribution is $750. You can see it on your left. The selling price is $2,500. So contribution over selling price is contribution margin ratio, which is 0.3. It tells you that contribution is around 30% of your sales. Now we can start. There are two ways to do this problem. There's something called the equation method, and there's something called the formula method. Whichever technique you use, you get the same answer. Let's do the equation method first. So I'm going to take you through this step by step, and the first way to do it, I'll teach you the equation method. You've seen it before. Go back to basics. Sales less all your cost give you profit. Sales minus, I put VC for variable cost, minus, I put FC for fixed cost, equals profit. Assume you got to sell X units to break even. So how would it look? There you go. 2,500X is the sales, minus 1,750X is the variable cost, minus 300,000 is the fixed cost, equals, it's break even, so profit is 0. So solve for X. X equals 400 players. Now let's do the formula method. Formula method, you have the formula in front of you. Which one is the best formula? We're talking break-even point, so it's on the left of your formula sheet. And do they want the sales in units or in dollars? It's in units. So it's the top formula on the left in your formula sheet, which is sales in units equals fixed cost over contribution per unit. Just stick the numbers in, you got it. Fixed cost is 300,000. The contribution per unit is 750. So the answer is 400 players. As I told you, whether you use the equation method or formula method, you get the same answers. Now, let's go on to part 2. Let me use the equation method first. from prior slide, you know that to break even, you got to sell 400 players. The sales revenue, therefore, is, you know, it's $2,500 is the selling price per player. So for 400 players, it's $1 million. So the answer is, to break even, the sales is $1 million. You have to sell $1 million worth of players to break even. Let's do the formula method. Which formula is it? It's break even, correct? And the formula is sales in units is fixed cost over what? Contribution margin ratio. We already figured it out, haven't we? Sales in dollars is fixed cost 300,000 over 0.3, which is $1 million. Which technique is easier for you? In the homework assignments, select the technique which you are more comfortable with. The equation or formula method. Some people like the equation method, some people prefer the formula. Go with what you're comfortable with. Let's go on to the next part. What was the question? If you sold 660 players, what's the profit or loss? I'm sorry, it was 600 players. If you sold 600 players, what's the profit or loss? The equation method is the long way. Start with sales. It's 600 at 2,500. You knock off variable cost. 600 at 1,750, which is $1,050,000. Therefore, the contribution is 450. Knock off fixed cost, 300,000. So your profit is 150. If you use the formula method, which formula would you use? It's definitely on the right side because it's not break even, and it's the sales in units or in dollars. They gave you the sales in units. So it's the, on your formula sheet, it's the top formula on the right-hand side, which is sales in units is fixed cost plus profit, the whole thing divided by contribution per unit, which is sales in units is 600. The fixed cost is 300,000. The profit is what you are trying to figure out. Take it as X. The whole thing divided by contribution per unit, which is 750. Now, it's high school algebra. You got to solve for X. So, 450, when you times both sides by 750, 450 is equal to 300,000 plus X, and X equals 150,000. Same answer. Now, let's try part 4, that you got to evaluate a marketing strategy. I think you already tried it, so let me give you the solution. Let me do the equation method first. If you follow her strategy, sales went up 10%. So, we're trying to figure out the bottom line profit for 660 players. It was 600 before. She says if you follow the strategy, the sales would increase 10%. So go back to basics. Sales is 660 players at 2,500 per player, which is 1,650,000. Variable cost 660 at 1,750 per player, 1,155,000. Contribution is 495,000. The fixed cost has increased because you have a commercial which is basically a fixed cost of 50,000. So the new fixed cost is 350. So the profit, if you implement the strategy, is 145. Is this a good strategy? Bad strategy, because earlier your profit was 150 and it drops by $5,000 if you implement this strategy. So the answer is don't go for it. Let's do the final part. And let's try the formula method first. This would be the most appropriate formula, sales in dollars, because they want it in dollars. So sales in dollars is fixed cost plus profit, the whole thing divided by contribution margin ratio. So sales in dollars, the fixed cost is 300,000. The profit they want to make is 300,000. The whole thing divided by contribution margin ratio, which is 0.3. So the answer is sales in dollars is 2 million. If you use the equation method, you get the same answer, except it's just a little bit longer. Here's the equation method. Go back to basics. Sales less variable cost less fixed cost equals profit. So 2,500x minus 1,750x minus 300,000 equals the profit you want to make is 300,000. Solve for x. 800 players. But they didn't ask for it in units. They wanted it in dollars. So how do you convert it? You know it's $2,500. That's the selling price per player. So 800 times 2,500. So the sales revenue is 2 million. You get the same answer. Except this was a little bit longer. Don't you agree? Now let's look at another problem, the Lenski Corporation. Here's the problem in front of you, and I'm giving you the questions. What I want you to do is just print it out. Here's more questions. C, Part D, Part E. Please print this out. Part F. Read it, then print it out, and we end up in Part G. There you go. So there are two things I'd like you to do. I'd like you to print this out. Then, with the knowledge you have, I'd just like you to try it. And then I'll go through this with you. If you want, stop this recording and have a crack at it. Parts A and B, you'll definitely be able to do it. The rest of them involve new concepts. Okay, are you ready? So, part A. They're giving you some numbers. Let's figure out the break-even point. If you use the equation or the formula, you get the same answer. Let me use the equation. Sales minus variable cost minus fixed cost equals profit. You know selling price is $30 a unit, so 30x is sales. Variable cost, $12 per unit, so variable cost is 12x. The fixed cost, 360, and the profit, because it's break even, equals 0. Solve for x. It's 20,000 units. If you want to convert it to dollars, what would you do? You know the selling price is $30 a unit. So repeat, sales to break even in units is 20,000 units. Sales to break even in dollars is $600,000 because it's 20,000 units at $30 per unit. So as an accountant, you have to tell Lenski Corporation you have to sell a minimum of $600,000 to break even. Let's go on to the next part. In part B, they said, okay, if you sell 30,000 units, what's the profit or loss? You'll notice I'm doing everything the equation method because I personally prefer that. If you choose to use the formula method, you'll get the same answers. So, compute profit if 30,000 units are sold. And I have a partiality for the equation method, so I'll use that. There you go. At 30,000 units, sales is 900. Variable cost is 360. So the contribution is 540. If you knock off the fixed cost, your profit is 180,000. Let's have a look at the next part. They wanted, in part C, you to figure out the margin of safety. I need to give you some background. There are two concepts which are popularly used to measure risk. To answer the question, how risky is this company? One is margin of safety. The other is operating leverage. They're both used, but to be honest, operating leverage is used more often than margin of safety. But if you read the Wall Street Journal or you read Business Week, you'll see these concepts, margin of safety and operating leverage. You'll see it talked about. Let's start with margin of safety. So we're going to answer part C, which is what's the margin of safety for Lenski Corporation. What does it mean? What does margin of safety mean? This provides information about, for lack of a better word, let me use the word cushion, a company has before it makes losses. The formula is margin of safety equals actual sales minus break-even sales. We already computed break-even sales, and we know the actual sales. From part B, the actual sales is 900,000. From the first part, we knew the break-even sales is 600,000. So the margin of safety is $300,000. This means sales has to drop $300,000 before the company gets into trouble. That's what it tells you. The sales have to drop $300,000 before the company gets into trouble. Ideally, you want this margin of safety to be as high as possible. Okay, let's go to part D, which deals with operating leverage. As I said before, operating leverage is a measure of risk. Look at the screen in front of you. It's a difficult concept to explain, but let me explain it this way. You have two companies, A and B. Company A has an operating leverage of 5. Company B has an operating leverage of 20. What does it mean? Company A, it means for every 1% change in sales, the bottom line profit will change by 5%. So if, for example, sales dropped 1%, the bottom line sales will drop 5%. It works vice versa. If sales increase 1%, the bottom line profit increases 5%. For B, for every 1% change in sales, profit will change by 20%. So if sales go up 1%, the profit increases 20%. That's a good side. The bad side is if sales drop 1%, the bottom line profit drops 20%. So which is more risky? Obviously company B, because it's more volatile. So operating leverage measures volatility in earnings. Let me repeat. Operating leverage measures volatility in earnings. If a person is conservative, you go with company A. But if you are a risk taker, you go with company B. So it just depends on what type of person you are. So let's go to part D proper. Let's figure it out. How do you figure out operating leverage? Well, there's a formula. The operating leverage for Lenski Company, the formula is operating leverage. How do you figure out operating leverage? How do you figure out operating leverage? Well, there's a formula. The operating leverage for Lenski Company, the formula is operating leverage is contribution over net income. I do want to emphasize there are different formulae for operating leverage, but this is the most popular. Even the Wall Street Journal, when they talk about operating leverage, they use this formula. So even if you see different formulas, don't worry. This is the most common formula. And based on Lenski Corporation, the contribution is 540. Do you remember from part B? Then the profit is 180. So the operating leverage is 3. And they ask you to compare it with another company, the Hillary Company. Your final conclusion, this company is not. What did they ask you in part E? If you look, they asked you how much do you have to sell to make a profit after tax? Now, this is very important. That's why I put it up in front of you. In the formula and equations, the profit must be profit before tax. That's what you have to put in the formula or the equation, profit before tax. So in a problem, if you are given profit after tax, you have to convert it to profit before tax. To convert, the formula is profit after tax equals profit before tax times 1 minus the tax rate. So let's do it for the Lenski Corporation. There's two steps. Step 1, convert profit after tax to profit before tax. Step 2, now you use the formula or equation method and figure out what they're asking you to figure out. So step 1, the profit after tax was how much? 350. You can't use 350 because it's after tax. You have to convert it to before tax. So PAT, profit after tax, equals PBT, profit before tax, times 1 minus tax rate. 350 is the profit after tax, equals, let's take the profit before tax as X because we don't know it, times 1 minus, tax rate is 30% or 0.3. So 1 minus 0.3 is 0.7. So 0.7x is 350. So x is 500,000. That's the number you have to use in the equation or the formula. So let's go to step 2 and let me use the equation method. Sales minus variable cost minus fixed cost is profit. So 30x minus 12x minus 360 equals, the profit before tax is 500,000. So 18x is 860. So x is around 47,778 units. So the final answer is, if you want to make a profit after tax of $350,000, you have to sell 47,778 units. Okay, that wasn't too bad, was it? Let's look at part F. Part F, they want you to evaluate a strategy. If they increase selling price by 20%, the sales volume goes down 30%, but whoever suggested it believes it's beneficial for the company. So let's figure out the profit if you follow this strategy. Increase selling price by 20%, but sales volume will drop by 30%. Use the formula or equation, doesn't matter. The selling price, you have to increase selling price by 20%. That was a question. Originally, it was $30. If you increase by 20%, it's $6. So the new sales, the selling price is $36. So the sales is $21,000 at 36, which is $756,000. Variable costs don't change. So $21,000 at $12, which is $252,000. Why did I say sales is 21,000 units? Because the original was 30,000. And they said if you follow this strategy, it drops by 30%. So 30,000 less 30%, which is 9,000, give you 21,000. Fixed cost, the contribution is 504 if you subtract, and the fixed cost is 360, so the profit is 144. So what's your conclusion? Originally it was 180,000. Now it's gone down to 144,000. So it's not a good strategy. It's not beneficial to the company. Let's look at part G. What's the new break-even point? You can use the formula or the equation, doesn't matter. For simplicity, I'm using the formula. Sales in units is fixed cost over contribution per unit. Fixed cost is 360,000. The contribution per unit is $24. So sales in units, to break even, if you follow the strategy, is 15,000 units. Why did the person who suggested this think it's a great idea? Let's compare the original situation with the situation if you follow this strategy. Before the strategy, the profit was 180. If you follow the strategy, profit is 144,000. But under the previous scenario, the break-even point was 20,000 units. Now it's gone down. It's 15,000 units. So you could make a case that it's a good strategy because the break-even point has declined. So if you're the boss, would you adopt this strategy or not? Yes or no? Take a few minutes and think about it. What did you decide? In real life, the answer is you go with the profit. So, not with break-even. Think about it. If you're an investor, what do you get excited by? Is it the profit of the company generates or the break-even point? It's profit, right? So, because the profit declines, the answer is it's not a good strategy. The final issue. Can you tell me what was unrealistic about what we did so far? Can you think about anything? What's unrealistic is we only considered just one product. How many companies make just one product? Our final example, let's take a situation where a company makes more than one. So let me repeat the questions one more time. What is unrealistic? We considered a company that makes one product. How many companies make just one product? Hardly any. So I'm going to give you an exercise where a company makes two products. It's up here in front of you. They make TVs and stereo systems, and the information is in front of you. What's the break-even point for the year? Do you want to try it before I give you the answer? If so, stop this recording and have a crack at it. Okay, let's do it. Let me use the equation method first. In the equation method, you go back to basics. But before you do that, what's the relationship between the two products? 2:1. You sell 2 TVs for every 1 stereo. So if you take, to break even, assume we sell X stereo, then we sell 2X television. Go back to basics, use the equation method. Here it comes. Sales less variable costs less fixed cost is profit. Sales is 1800x, variable cost is 1200x, fixed cost is 100,000, profit is 0. Now, you'll think, well, how did I get 1800x for sales and 1200x for variable cost? I'll show you in a minute. But assuming that what we have in front of us is correct, solve for x, 167 units. The question is, one more time, how did I get the sales and variable cost? The answer to break even is stereo is 167 units. So the TV, you have to sell 334 units. So roughly, you got to sell 167 units of stereo and 334 units of TV for the company to break even. How did we figure out sales and variable cost? Really simple. Here it is in front of you. If you sell 2X TV, the selling price per unit is 500. So the total sales for TV is 1000X. If you sell X stereo at 800, it's 800X. So the total revenue is 1800X for both. If you compute variable cost, 2X for TV, 2X at 300, 600X. For stereo, X units at 600, 600X. So the variable cost is 1200, and you stick that in the formula or the equation, and you got your answer. What would happen if you used the formula? It's identical formula. Sales in units to break even is fixed cost over contribution per unit, but this contribution per unit is called weighted contribution per unit. The weighted contribution per unit takes both products into account. So what was the selling price weighted? Which it was 1800X, do you remember? What was the variable cost which took both into account? Do you remember? It was 1200X. I'm sorry, 1800 and 1200. So the weighted contribution was 600. So sales in units is 100,000 fixed cost over weighted contribution per unit. The weighted selling price was 1800. The weighted variable cost, which took both into account, is 1200. So the weighted contribution is 600. Answer is 167, but then you do it as before. The stereo is 167, and the TV has to be double that, 334. How did you figure out computation of weighted contribution per unit? One more time. Here it is. The weighted selling price is 18. The weighted variable cost is 12. The weighted contribution is 600. 600. What have we learned? We learned how to figure out break-even point, how to figure sales volume for at different profit levels or profit targets. We learned how to factor tax in the computation. We learned the concepts of operating leverage and margin of safety. And we learned how to figure out break-even when the company sells more than one product. That's the end of this module.